How does a portfolio manager look at it from the point of view of asset allocation? We're seeing Trump flip-flopping on announcements. There is a great deal of uncertainty which is coming into play. That's creating a volatility in place for a fund manager who's planning to allocate through various geographies and asset classes. What should he be reading, and how do you see that translating into investments into geographies or asset classes?
Yeah, and this is the debate that we're all having in the asset management community, and I guess more broadly, investors at large. And I think one thing I would sort of caution against, I think trying to predict the next headline, the next kind of bit of news flow with regards to trade negotiation or whatever else it might be with regards to the trading policy set is really hard. It's a fool's errand to try and understand exactly or try and forecast exactly the next step in a negotiation pattern. What I think we can do, though, is try and think, where are the boundary conditions, right? Where are the bigger kind of sort of dynamics, which mean that will prompt a reversal in a particular path or the rhetoric. And we're kind of framing this in the notion of thinking about the immutable economic laws that are actually going to govern what the end state looks like. And there's two that we particularly highlight. One is to do with the idea that you can't just, if you like, you can't just kind of change the terms of the trade deficit without having an impact on the foreign sort of flow and foreign funding of US assets. And I think we saw that sort of immutable law dynamic really coming into fruition right at the start of April, where we saw the 90-day kind of pause on tariffs come immediately after the fears in the treasury market of spiking yields. And I think you see there that the idea that the market forces of the yield movements kind of then influence the ultimate direction of travel of policy. I think you also saw some element of that when it comes to the second immutable law that we think about when we're trying to govern the space and navigate the space, which is the idea that the trading interconnected nature of the global economy has taken decades to build, and you can't just change it overnight without experiencing or anticipating some material economic damage. And I think when you saw in the course of the last couple of weeks the idea that leading CEOs were kind of pointing out to the world that there could be some impact here from kind of trying to change too much too quickly, you then again started to see some softer rhetoric come out, and therefore a bit more of a market rally in the course of the last week on account of that softer rhetoric. So trying to guess the very next move is really impossible. Trying to think about what are the bigger picture boundary conditions that can then influence the ultimate outcome, I think that is where we need to think a little bit more. And in that spirit, in that vein of taking that slightly bigger, longer term approach, that's where we see the opportunity arise in India, because the structural dynamics that we've been talking about for a period of time, the demographic dividend that India faces, the digitization of the Indian economy. These are structural drivers which we think it's important to focus on, because it can be very easy to get carried away with the very near term and only focus on, if you like, the very near term tactical dynamics. We actually sometimes need to take a little bit of a step back, and that's where the structural opportunity lies. And the final thing I'll say in answer to your question, when we're building longer run portfolios, for an international investor, we would indeed think a little bit more about holding a greater allocation to benchmark weight in Indian large cap equity.